My name is Chris Anderson, and I'm a product manager with Itiviti. So ETFs, you can actually trace their history to the first pooled and diversified investment vehicle, which was actually in 18th century Amsterdam. So there have been a few key milestones since the 18th century. So in 1890, we got the first US fund. In 1924, we got the first open-ended fund. In 71, we got the first index fund, and that was important as the first foray into passive investment. Then 89 and 90, we got the first attempts at exchange-traded funds, before finally in 93, we got the first and modern ETF, which is the SPDR, and that continues to be one of the biggest to this day. So there's been a lot of evolution in, 250 years, and there's a couple of drivers, consistent drivers, that have pushed evolution along that path. First of those being the increasing investor appetite for passive investment strategies, and secondly, the push for an ever more low-cost and efficient vehicle to wrap those strategies. So those are the two key drivers that have taken us to today. 2016, the size of the ETF market globally was something like $3 trillion in assets under management, and that was broadly divided into 2.29 trillion in the US, about 500 billion in Europe, and then the rest in Asia, which is around 300 billion. So there's quite a bit of an outlier there, with the US being by far the biggest market. And there are a couple of, three actually, key differences between the US and the next biggest market, being the EU, which can help explain why the US is such an outlier. So the first one of those is transparency. The US is way more transparent in that every ETF trade needs to be reported. That isn't the case in Europe yet, because ETFs were not originally recognized under the MiFID implementation. So transparency is a big thing, and the first sort of differentiator. Second of all is there's a much higher retail participation dynamic in the US as well. So recent studies point to almost 40% of households owning ETFs in the US versus only 11% in Europe. There's a much higher retail dynamic in the US market as well. And the final thing is the way they are traded between the two regions is also fundamentally different. So in the US, about 70% by value is done on exchange and concentrated on three main exchanges, whereas in Europe it's kind of the opposite. There's 70% done over the counter, and what is remaining and is done on exchange is typically fragmented across many exchanges, countries, and currencies. So three main reasons, as I see it, that explains this disparity. So there are a number of tools in our experience that we think you need to seize the opportunities with this new trend. And those can be broadly divided into the prerequisites, the sort of very basic level that you need to get into the market, and then the differentiators, which are the game changers that can give you the edge. So I'll briefly go through the prerequisites, and they cover things like static data management, getting the fund composition to your platform. They cover things like connectivity, being able to connect to the various markets you need to, and the market models that they use there. And the final thing is risk and inventory management. So having ETF-specific risk management is very important. So those are the prerequisites, but the game changers, these are the ones that can add edge. This is how you differentiate yourself. And these cover things like pricing. So ETF pricing can be quite tricky, especially if you consider large ETFs tracking indexes with hundreds or even thousands of names. So you need ETF-specific pricing. Quoting and trading algos as well are very much part of your edge, and these are the brains behind your strategy. And we're seeing a couple of trends there towards smarter logic over speed and scalability as well. So those are two very important things in your trading platform. And the final differentiator is hedging. And this is probably one of the most bespoke things. So a trading platform needs to have the expressiveness so a trader can really lay out their strategy, how they intend to go to market and hedge. So buy and build is probably one of the most important themes that we're seeing. There's a number of things that are becoming expectation. And these are things like performance, scalability, multi-asset class solutions, but buy and build continues to be the biggest one. Because as I mentioned earlier in the tools, the differentiators, they're really in the way you build on them, the way you program in your IP. That is where the edge is. So things like pricing and hedging, that is where you need to build. And a trading system needs the flexibility for you to add that logic and to go into the market and take that edge.